Test. Test. Test.
Please.
Okay guys, so I am just testing how to stream in YouTube and Facebook at the same time. Well, nonetheless, regardless of our intent, let's talk about what's happening with the market. So guys, welcome to our London Open coverage. Now, I think I should say welcome to a new world. A world where everyone is unsure about what's happening. The world of Mr. Donald Trump. Why do we say this? Well, let me show you a chart. Let me just pull up something here. Let me replace our usual chart and show you something. So, we're looking at a chart of the different major pairs, and as you can see, you have ongoing risk off. Yen strengthening, Swiss franc is strengthening, euros pushing to 3-month highs, GBP same thing. Even if you look at your commodity currencies, Aussie and Canadian dollar, and they're both gaining on the greenback. So why is this? Well, earlier today, or should I say last night, while all of us were asleep, we had Donald Trump announcing tariffs. So, what are tariffs? Basically, tariffs are taxes for importation. Now, if you come to what did Donald Trump do? He basically imposed a 10% tariff on everyone in the world, on every country in the world that trades with the US. And for some select countries, he is imposing a higher tariff. From my recollection, he's imposing a 24% tariff on all products from Japan. He's imposing a 20% tariff on all products from the EU. Now, what does this mean for the average American? For the average American, this means that they will be paying more for the goods and services that they consume. Okay? For the rest of the world, what does this mean? This means that there would be less trade. Okay? There will be less global trading, there will be less economic activity, because some of those, well, let's put it this way. The US has been the primary consuming economy for the last, I would say, the last 70 years. The US economy itself is a consumption-driven economy. While you have places like China, Japan, Germany, these are trillion-dollar economies. These are highly developed economies, but these are economies that's based mostly on the idea of exporting. Okay? These are economies that's export-driven. And the US has always been the economy that consumes the exports of the rest of the world. So this effort of Trump, this tariff, basically would mean that some of the businesses in these countries would have a hard time. That's why equity markets are dropping across the board. But the main issue is the US. Tariffs mean that things will be more expensive for the Americans. And another consequence of this would be inflation. Okay? If the cheaper import alternatives will not be available, then, or not, okay, let me put it that some other way. Because of tariffs, things become more expensive. And if things become more expensive, what else happens? Probably you would be consuming less of, especially for those unnecessary items. And with less consumption, what does that mean? Less consumption means that the US economy, which is, as we said, is primarily consumption driven, would probably slow down. And here's the thing. The solution to a slowing economy is for the central bank to lower interest rates. In theory, lower interest rates would mean that businesses would be encouraged to invest into production, people would be encouraged to consume. All right, this is great. But tariffs create another problem. It creates inflation. And the solution to inflation is increasing interest rates. So this puts the Federal Reserve in a bind. What are they supposed to do now because of tariffs? Okay, probably their plans from last year when Biden was president about cutting interest rates aggressively this year, that's not going to happen anymore. Okay, they have to think about the inflationary impact of the Trump tariffs. So, okay, on the one hand, we're saying that there's an argument for the dollar to strengthen because the Fed would have to be forced to lower rates given the slow economy. But on the other hand, we're saying that on the one hand, because of inflation, the Fed would be forced to raise rates, and classically, higher interest rates would mean a stronger currency. Higher interest rates would mean that you attract overseas money into your economy, okay, lazy money. But because this inflation is really accompanied by a slowdown in the economy, it's not inflation that's a result of a heating economy, then there's that dilemma for the Fed to how do they address the economic slowdown. So what am I saying here? What I'm saying here is we are now facing, or the US is now facing, a period of stagflation, a period where there's economic slowdown in the economy, and at the same time prices are rising. Last time that the US was in this situation, I was just still a kid. Okay, I was probably okay, I wasn't wearing diapers at that point already, I guess. But like I said, I was still a kid. I didn't know anything about financial markets. I didn't know anything. I probably didn't even know how to add one and one plus one. Okay? My point here is that was so long ago. The policymakers who were in charge back then, okay, at that time, the president of the US was Ronald Reagan. The policymakers that were in charge back then, they're all dead now. Okay? And of course, we know. Of course, there's always documentation on what the central bank was doing back then. And yeah, the central bank in the US back then was raising interest rates to address the inflation. That was their focus. Remember, the central bank's job is to make sure that inflation is manageable, that prices are rising slowly, so that everybody benefits with the growth of the economy. But now you've got inflation. You probably will see an increase in interest rates soon, but this is not a classic situation where you raise interest rates to address inflation. This is a situation where the economy would be slowing at the same time, or is slowing, going to slow down at the same time. And that means that the US is facing the potential to go into a recession at some point. Okay? Less consumption for the US will mean less economic activity, will mean potential recession. And what does that mean for us in financial markets, for us who trade currencies? Well, that's what we're seeing right now. You've got the big banks already pricing in the idea of a weaker dollar over the next couple of months. I guess until such time that Trump, for some reason or some, gets enlightened. I don't know how he will get enlightened, but we are in that situation. So what do we do as far as trading is concerned? Well, normally open of London markets for me is a great time to take a trade. I would rely on momentum coming in as people wake up and start looking at their screens, start trading. People from Europe are doing that, and then you've got the Asians thinking, oh, it's time for us to close our trade. So that creates transactions. But the problem at this point is you've already had a run in your euro during the Asian session. So I'm actually thinking, what the heck should I be doing at this point? If you look at your chart in the hourlies, you see that a flag pattern was triggered. We're actually near the target of that flag pattern. If I go dailies, we're actually testing the high for the year in euro. In fact, we've already pushed to the high in euro. At this point, I'm not willing to do anything. I'm not willing to take a trade. Note that we have a psychological resistance in euro at about 1.1. The thousands are always psychological levels. 500s are also psychological levels. So what's my plan here? Well, I guess my hope for getting a trade now is for the market to give me better prices. If for some reason over the next few hours we see those who made money earlier from Asia booking profits, then we may be able to get a bit of a pullback in our euro. And where's my pen? Let me just wait for my pen to pop up. Okay, my pen's not popping up. Okay, so at this point, folks, we can't do anything at this point for the moment. It's too, let me put it this way. I think that your euro is overbought intraday, but the market structure has changed. Your daily charts, in fact, you have to go to the weekly charts. If you look at your weekly charts, we're now entering this level that we last saw in July last year. The next strong resistance level, I think, would be around that 1.12 area. So over the next couple of weeks, we will be looking for euro to push to that 1.12 area. Now, while we're talking, even though we're talking about 1.12 as our target, remember we are intraday traders. We don't want to hold trades for weeks. We don't want to hold trades for days. Especially if you're a retail trader, you are using leverage. You're not the bank. You're not putting in 100 million for a 1,000 lot trade. Okay? You're not putting in 100,000 for a 1 lot trade. You're putting in probably $1,000, $500 of your own money. So you don't want to trade long term under those circumstances. So for now, we cannot do anything immediately in euro. Again, it would be best to just wait for a pullback to happen. We know what the long term trend is, and we will just try to try to join that long term trade once we come from a reasonable level. What's reasonable for me? Let me see a clear pullback. In fact, I would suggest you draw some Fibonacci retracement levels from the lows, from the close of the US yesterday, because the high for now is active. So really, it's not even a good idea at this point. You have to wait for prices to stabilize before you start drawing your Fibonacci retracement. So let me just delete those. And I come back with the idea that I can't do anything at the moment. Now, things to watch out for. We've had ADP employment change numbers yesterday, and tomorrow you have non-farm figures from the US. What about non-farm? Okay, these are non-farm figures from March. Remember the time when the federal government kept firing a lot of people? By the way, they're now talking about closing the Department of Education in the US. I guess Trump wants more dumb Americans. Anyway, so a lot of things are developing a confluence that says you gotta dump the dollar. But tactically, we are not in a position to do anything. If you do decide to take a trade, I would suggest using a small size, given that we are already overbought, given that this has moved by average daily range already. Now, this could be one of those exceptional days when instead of 80, you get 160 pips for today. But I don't want to bet on that. I can just imagine the probability for that happening. Okay? So, for now, let's not do anything. Let's not get too carried away with a rally in our euro. Best thing to do, wait for a pullback. If you start seeing hammers, okay, looks like, well, we have the market, we have euro London Open already. Let's see if it pulls back. If it does pull back and we start seeing hammers, then we can join the buy side. No pullback, not for me. Better safe than sorry. You're not a bank. You're not some high net worth individual who's trading his own money, who's trading full margin. You're a margin trader, and margin traders have to be very careful about what they are doing. So, folks, I guess that's it for this. Since, the simulcast failed actually. Looks like Facebook did not pick up. So, guys, I'll see you for the next test.